And let's introduce you to the first one. We're delighted to be joined today by Glynn Jones from the Bank of England, returning to our show. Great to see you.
Yeah, it's nice to be asked back.
Have Bank of England agents and economists and people in your circle ever been so in demand and so popular as they are at the moment?
I have to say, and perhaps it's not a good indication, but at the moment, yeah, there's a high level of interest in the economy. We are doing numerous presentations to packed houses, and more importantly, there's a lot of engagement with the material we're presenting, because clearly economic issues and inflation especially is at the forefront of the minds of businesses and obviously households as well.
We're going to get into all that, and hopefully we've got some questions from the studio audience to come as well. But for people that don't know, just explain a bit about your role, how you fit into the bank and what you do.
Well, I work for the Bank of England's agency network. So what's the agency network? Well, basically we've got 12 regional offices in the 9 UK economic regions and the 3 devolved nations of Britain. And from that, we have a couple of agents who work, and basically we gather economic intelligence that helps inform banks' monetary policy deliberations and the decisions of the Monetary Policy Committee. How do we gather that intelligence? Well, that's largely by meeting up and down the country, basically, so from the Scilly Islands up to the Shetlands, across the UK. We meet businesses and basically discuss business conditions. So we will chat with them essentially about demand conditions, supply conditions, costs and prices, credit conditions, not just the things that they've been seeing over the past year, but also their expectations for the year ahead. And that's actually quite important in setting monetary policy, which is sort of forward-looking. So that's a sort of day-to-day job. And some of the audience who are awake, actually, none.
All right, so far.
May be wondering, well, why does the bank do that? And indeed, not just the Bank of England, but actually other central banks as well. So the Federal Reserve, the central bank in Australia have sort of similar functions. Why do we need to do that? Because actually we've got the Office for National Statistics. They collect a slew of statistics. What do the bank agents add to that? And the things that we can add, clearly, that, if you think about those statistics, a lot of them are backward looking. They're released with a lag. They don't tell you anything about the direction of the economy going forward. So there are gaps in that data, but also they don't tell you anything about sentiment. And importantly, given the sort of events that we've seen and will no doubt come on to recently, they don't tell you a lot about how businesses are reacting to specific impacts and how that is impacting their behaviour going forward. And that's the sort of thing that we can pick up through these direct discussions. And just one final thing. So in terms of the role, if you're interested in economics, there we go. It's a great job. Why is it a great job? Because when you think about it, we engage obviously in doing the quarterly, presenting the quarterly forecasts as and when they come out, largely but not exclusively to business audiences. But then we get the finer grained detail around what's happening in the economy from all the discussions that we have with sort of various businesses. But then also out to the regions, we get various members of the Monetary Policy Committee coming to visit. And obviously you spend time with those people, and that includes the Governor of the Bank of England, who was visiting us as recently as July, although that now actually seems a long time ago.
That's 3 prime ministers ago.
At least.
Like that, so, yeah.
At least.
So inflation, let's talk inflation. The autumn statement last week suggested, didn't it, when we had the OBR statistics, that it's maybe not going to peak quite as high as some people were fearing a few months ago, and next year it's going to tail on away a little bit. What's going on with inflation? Why, in a nutshell, why is it so high at the moment, and what's being done to try and bring it back?
Well, this is a really important point. So clearly, if it's okay, I just want to delve into this in a little bit of detail so that we get an understanding of why the bank is doing what it's doing and what are the expectations around inflation. Importantly, what's driving that? Why is it so high? The October figures that we saw released, inflation of 11.1%. Our target is to try and maintain inflation at a low and stable rate of around 2%. It's the highest it's been in 41 years. So unprecedented levels of inflation, partly because there's been some unprecedented developments within the economy. There are three that I'm going to highlight. Actually, no, there are four I'm going to highlight. I'll limit myself to that. But first, before I just do that, what I want to do is to try and contextualize to the audience here the sort of specific pressures that we were seeing in the UK, because clearly there have been some global events that mean global inflation is high, not just here in the UK. So if you look at the euro area, inflation is also in double-digit territory. But what's driving that? The key driver there is energy. And that is because that economy imports quite significant amount of gas, and particularly Russian gas. And we've seen that with exposure of the German economy, for example. Their domestically generated inflationary pressures are relatively modest because they've got more slack in the labour market. This is something I'm sure we're going to be coming back on to. If you look at then at the US, inflation is not quite as high as it is in the UK. It's around 8%, and actually, interestingly enough, is declining. They, indeed, I was told by a friend of mine from the US recently, because I was pointing out, well, you know, it's not so bad for the US because the US is fairly, you know, independent in terms of its self-sufficiency in terms of energy. He said, no, it's not. We're only 97%. You know, sort of self-sufficient. Whether that's actually correct, but certainly, you know, large energy-rich company. What's driving inflation in the US is very tight labour markets and domestically generated inflationary pressures. Okay, so coming on to the UK, what's happening in the UK? This is quite interesting because our inflation, when we look at what's driving that, is quite broad-based. So on the one hand, we've got the energy pressures, and that's a significant driver here in the UK as it is in Europe. But also, we're seeing that in terms of tradable goods, but also, actually, we also see strong domestically generated inflation, and that's the thing that central banks worry about, which is why the Fed and the Bank of England have been tightening rates. Now, sorry, apologies, I know it's a long answer, but I just wanted to delve into, if I could do, and if this gets boring, start looking at your watch or fiddling with your tie or something.
I'll tell you what, let me ask you a question in the middle of this, though, because I think it's relevant to it.
Yeah.
Because some people are saying, well, are we trying to use interest rates as a tool to bring inflation down when a large proportion of what's impacting on inflation is actually out of our control, though?
Exactly, and we hear that a lot from businesses who variously say, look, it's a demand shock, it's an external cost shock. And some of it is an external cost shock. But the problem here is where that becomes embedded in domestically generated inflation pressures and becomes self-sustaining. And in a nutshell, that is what's happening here in the UK, and we'll unpick that further. But if I just come to what is particularly driving inflation and how has it got to this double-digit level, and I just want to highlight very briefly three factors. The first of those, of course, is significantly the war in Ukraine, the tightness around gas supplies as a consequence of that, and the UK is particularly exposed to that. We are exposed to that because we are a net importer of energy, but also, unfortunately, in terms of our production and consumption, that is also highly dependent on gas. So that's the first factor that is significantly driving a peak in inflation. The second factor really stems from another unprecedented event, the pandemic. And out of that, you've got significant disruption in demand and supply terms. Because if you think about it, you know, during that period, our ability to go out of the house was restricted, not just in the UK, but globally. So a lot of us sat at home, ordered goods online. So the demand for goods globally shot up, but at the same time, the supply of those was constrained because factories were also being hit, the factory output, by the pandemic, so we're having to close. You've got a lot of other disruption during the pandemic, including we saw shipping rates spike at enormously high levels. So some of that is then reflected in tradable goods, and that is imported into the UK. Why? Because we are also an importer of tradable goods. So that's the second factor. The third factor, I'll try and hurry it up because I know we haven't got all day. The third factor is this domestic factor. So those are the two external cost shocks which sort of set the ball rolling. But unfortunately, those have come at a time in the UK where we have historically very, very tight labour markets. So in effect, you have an external cost shock, two external costs coming in, hitting the UK economy at a time where actually the risk of that becoming embedded in domestically inflationary pressures is greater because our labour markets have never been this tight. And again, you know, this is a sort of historic precedence. I mean, unemployment is now not been this low for nearly 50 years. And then the fourth factor, I'm just going to mention very briefly, we've seen sterling depreciation, particularly against the dollar, and that also is inflationary. Why? Because a lot of commodities are priced in dollars.
It's edged up a little bit, hasn't it, in recent weeks?
It has, but overall, I mean, clearly since the 2016 referendum, we've seen weakness in sterling and then a lot of volatility since then, but at a generally lower level. Clearly it has picked up from where we were going back post the Kwasi Kwarteng's mini budget when it was almost at parity.
Are there any signs that we're like seeing a peak, or could it get higher?
The expectation of the bank and the OBR were both sort of agreed about that in terms of the forecast, although there's huge uncertainty around that, is that we should be seeing the peak at the moment. Right. And actually during the course of next year, I mean, unfortunately it's going to remain high over the winter, but during from the middle of next year should start to fall back quite sharply to more like, by the end of 2023, 5%, which is still very high, still well above our target, but it's
better than where we're at now.
It certainly is.
But so boiling things down then to a Shropshire level, are there certain sectors of the economy which are at the sharp end of what's going on at the moment? And from a Shropshire point of view, does that mean that the county is at greater risk or at lesser risk in some of these areas than other parts of Britain?
Okay. Well, if you look at the Shropshire economy, let me make 2 points. I mean, the recession itself will probably come on to what the forecasts look like, but we've seen a contraction in GDP already. There is a concern about recession. The Shropshire, but hopefully that will be relatively shallow. The Shropshire economy is generally a relatively resilient one because it's not overly skewed towards particularly vulnerable sectors. And also it's largely SME based, and also household incomes are at a reasonable level. You haven't got the concentration of vulnerable households that say we've got in other parts of the region. So broadly speaking, actually, you're looking at a fairly resilient economy, but obviously within that, there are some vulnerabilities.
Anybody got any questions for Glynn? We've got loads more, but anybody got anything else they want to add at this point? We'll keep going. Well, I mean, we're going to be talking about skills and recruitment with our panel in a few minutes' time, but why is the labour market so tight? Because in my sort of fundamental good old O-level economics days, I always thought if we're entering into a time of recession, that creates unemployment, and so there's lots of people looking for jobs, but that doesn't seem to be the case now.
Exactly. I mean, because we've had these unprecedented effects, actually the economy is not necessarily behaving in the way we've become expected it to. And just to sort of put this into context, with unemployment at 3.6%, the lowest it's been since 1974, we've had really a supply side shock. That's the best way to sort of describe it, which is becoming increasingly apparent. As the pandemic recedes, things aren't coming back quite to normal. And there's a number of factors that I think, people would suggest are contributing to this tightness. Very briefly, those include demographic factors. The workforce is aging, so basically the supply of working age population is shrinking, so that's a sort of slow burn issue in the background. Since Brexit, that has impacted on the availability of migrants from Eastern Europe and Europe generally, so that's a factor. But again, there is something specific to the UK here. And this is the point I really want to sort of focus on, and this is part of the shock that we've seen. And that is essentially that the UK, unlike most other advanced economies, possibly with the exception of the US, but unlike most advanced economies, we now have higher levels of economic inactivity than we did, much higher than pre-pandemic, whereas for these other countries, by and large, their economic inactivity levels are lower than where they were pre-pandemic. So what's driven that increase, which basically is substantial? So we've lost something like 500,000 workers. Those essentially relate to, the biggest driver of those is ill health. So things like long COVID, chronic sickness, mental anxiety, which I hope the audience aren't getting and I'm not contributing to here. And there's a relationship probably there with some of the significant backlogs we've seen with the NHS. And that's quite important because that means that the labour market could remain tighter for longer, because you've just assumed that if economic inactivity levels are driven by long-term sickness, that's not going to unwind quickly. And so what that does is contribute to the tightness of the labour market further out, and that underpins, some of the wage inflationary pressures that we've been seeing.
And from all of these issues that you've talked about, what are your contacts in Shropshire telling you that they are most concerned about at the moment? Is there a sort of a league table, a shopping list of these?
Yeah, I mean, let me think. So actually there's a couple of things that have come into sharper focus since May, and a few new things. So the things that have come in, that I mentioned back in May, that have come into sharper focus have been the concerns around the slowing economy. That slowing economy has now arrived, but it's arrived at a time for a lot of firms where energy costs particularly and labour costs are much higher. And that then becomes a big concern, because in a slowing economy, it gets very difficult then to pass those cost increases through into prices, particularly for consumer-related businesses, because real incomes are being squeezed, and if you put your prices up too much, then you're going to lose demand. So that has come into firmer focus for firms, and is putting particular pressure on the retail and hospitality sector. Secondly, I mentioned last time, and that continues to be the case, despite the fact that the economy is slowing, the labour market remains tight, recruitment remains an issue, even though hiring intentions have eased a little bit. A lot of firms suggest that their inability to recruit is actually biting, to the extent that their sales and revenues, if they could recruit in the way that they want to, would be higher. So when we look at the economy and the performance of the economy, that is being affected not just by demand side factors, but by an array of supply side factors. So those were in play before and have continued. And I'd probably add to that a couple of other ones, notably, not surprisingly, financial conditions have tightened. They've tightened because bank rate has gone up on the one hand, but also the risks facing the economy have increased, and the combination of those mean that the availability of finance and the cost of finance, particularly for SMEs, and bearing in mind Shropshire is largely an SME economy, have started to rise. Now, for some firms, that is going to impact on their viability, and we've certainly seen in terms of insolvencies, those have started to tick up. Small firms, construction sector, retail sector particularly, but generally, this is affecting firm behaviour and the things that they're doing as we see the economy slow. Generally, the supply chain issues have continued to ease, and those global cost shocks have continued to ease as well. But, because I don't want it to sound overly negative, let's just put this in context. There are still certain sectors who are performing very strongly, particularly ones who've been facing capacity constraints for some time. So anything in IT and digital continues to do well. Recruitment firms are continuing to see quite strong revenues, and sort of basic services such as audit, still sort of robust demand. So it's by no means sort of doom and gloom across the economy, but there is clear evidence that it is slowing.
And some of the impacts of that will be, there'll be a bit of a lag before it all starts to come through, I guess, as well, won't there? Has anybody got any questions for Glynn while I've got them here?
No.
This is looking good.
Good.
Well, in that case, final point then, really. I mean, I think the last time we were talking, you just produced a quarterly forecast, and there's the latest quarterly forecast out a couple of weeks ago. How dramatically are each of those changing, and are there any particular things out of the latest one that you ought to flag up, that you feel is important to flag up today for Shropshire businesses that you've not covered yet?
Okay, so just by sort of way of context again, I'll probably state, it's just interesting to note that there are some distinguishing features facing the UK, in that again, as an economy overall, we've not yet come back to our pre-pandemic levels of output, which distinguishes the UK from and most of the G7 economies. And the forecast does not look particularly great, not surprisingly, given the very challenging conditions that we are facing. So, clearly businesses are expecting a slowdown, and are right to expect that. We see that GDP is likely to contract. We're seeing that Q3. We're expecting that to continue through next year and into the first half of 2024. The good news is, which seems to be mirrored by in the discussions we are having with most businesses and the behaviour that we're seeing, is that looks like it will be a relatively shallow recession, nothing like the general financial crisis or the sort of contraction we saw in 2008. But the good news in terms of, again, when we speak to most businesses, they've been through the pandemic, they've been through a recession, they've been through a pandemic and Brexit. They'll come through the recession, particularly if it's relatively shallow. The difficult thing for firms at the moment, I guess, is this is coming at a time when their cost bases are increasing, and particularly those energy costs, which will be challenging.
So just as well, they're battle hardened then, really, isn't it, from that point of view? Glynn, thank you so much for coming in.
Pleasure.
It's always great to see you. Ladies and gentlemen, Glynn Jones from the Bank.